Kartik Jhaveri. He's the founder and director for with Transcend Consulting. Kartik, many thanks for joining us once again on this episode of The Money Show. So how are you reading into this RBI report? I mean, I'm sure it's not exactly the sight for sore eyes when you see that a household's savings are getting depleted, assets are also getting depleted, but debt is on the rise.
Yes, of course. Your colleague Priyanka read out quite a lot of very, very depressing statistics, so to say. I mean, and that's the reality, right? That is the ground fact that a lot of people, obviously their savings are gone down. Obviously, loans will go up. But, the starting point of all this, the income has gone down. A lot of people are not earning as much as they used to earn, or they are earning maybe half of it. Certain industries, which are in the service sector, those industries now got affected as badly as maybe the manufacturing or maybe the services, things like tourism or a person-to-person interaction. So while those statistics are there and which are absolutely there, I want to also highlight in the same breath, I want to highlight some other statistics also. For example, the index has risen 100% since the last 1 year. Small cap funds have done more than 100% returns. Pharmaceutical funds have done 65, 70%. People who invested in equity markets, their portfolios, they saw them going down by about 40 to 50% at the peak of the COVID, as soon as the lockdowns began in about March and April last year. But they are also handsomely sitting in profits. People whose returns were looking like single-digit SIP returns and single-digit, sort of very, very measly sort of returns until about last year, which was a backlog of the last 3 or 4 years, have all gone into double digits, and everyone's portfolio is looking okay. So there are a lot of positives also for the ones who took action, for the ones who took better and proactive action. But at the same time, yes, there's a lot of apathy from the administration. There's a lot of bureaucracy. There is a lot of social support that I see. The Lions, they're doing a lot of activity for the general, benefit and for the general goodwill of the society at large. But then there are also places where the bureaucracy sets in, and you are not able to do as much as you would like to do. Social support is not there. I mean, there's lesser said the better. We just don't have it. Our stimulus packages that are announced by the government, and unfortunately nothing like the direct benefit packages that are announced in the western parts of our world. But having said that, these are mostly, the programs and stimulus loans, etc. But at the end of the day, there has to be business, there has to be activity for even people to avail those facilities and so on and so forth. So all this put together, yes, there's one side which is really suffering, and there is a smaller percentage, 80-20 rule, which is always playing out. But at the same time, there's a lot of sections of society which has, you may not like it, but have prospered quite a lot in the last 1 year as well. So the rich and poor divide has gone much wider. It's going where, the have-nots, by the time they come back to normalcy and they start building up their reserves and savings and all of that. So yes, overall, not a very happy scenario to be in, but I think a lot of lessons that we have learned over the last 12 to 18 months or so.
Yeah, that's a fair point, that while, yes, these savings data may indicate this, but look at the way, we've seen returns from equities, from especially small caps and mid caps. So that disciplined SIP that a lot of these individuals may have continued to do even during the pandemic has definitely, reaped rewards quite a bit. Now, Kartik, we are attempting to go back to normalcy, albeit slowly and also with a very cautious stance, because even as we've just come out of the second wave and, states and localities are looking at unlocking, you have this Delta variant news and the third wave that's sort of just lurking around the corner perhaps. So it's what we call as being cautiously optimistic. So keeping this in mind, keeping the threat of a third wave in mind, while of course looking to correct all the financial actions that we had to take forced by the pandemic, how can we start to repair the household finances?
The easiest thing that all of us have in our control, and luckily in this kind of a scenario, there are not enough opportunities to spend money. So all that discretionary spending that we used to do, for luxuries and for gifts and travel and all of that, that that income save up on, they automatically get curtailed. We get a little more disciplined about it and get a little bit more responsible about what we need to put aside. Start building contingency as the priority number one, because you will need cash at any point of time. God forbid, if anything were to happen, you will need to have some liquidity and cash. The other thing is health insurance, of course. So if you are still one of those, population of the country who does not have health insurance or adequate health insurance, or who is still depending on their corporate packages and corporate things, somebody is going to come to you with a golden parachute. I think it's really time to make sure that each one of you have, all the people who are listening to this, have at least about 10 to 20 lakhs or maybe more of insurance cover. Now, I will tell you something very magical about this health insurance is the cost difference or the premium difference between a 20 lakh cover and a 30 lakh cover may be very marginal. It might sound like a big jump, but it's really not so large. So go back to your advisors, talk to your companies or your brokers, whoever you are working with, or check them out very well. Get yourself a good health insurance package if you don't already have one. Because I think everyone has learned that, God forbid, if something happened medically to you, so many years of savings get wiped out and you just, go back about 5 to 10 years in terms of your financial status. So I would really want to emphasize health insurance. If you don't have it, please get it. Contingency funds, start building it. Credit cards are a good idea, but use them very judiciously. In the sense, use them as an emergency device. So what happens is, if you need the money is available. But that doesn't mean that you start spending and then rotate the credit, because that becomes very, very dangerous. Okay. And of course, expense control, which is obviously in our hands to try and curtail the discretionary as much as we possibly can. Finally, after all this, if there is some amount of money, however small it might be, even if it's like a 500 or 1,000 rupees, start putting it into the equity markets, because that's the only place which will accept small denominations, and that's the place which will democratically grow your wealth over a period of time. So if you've not started already, I think it's time you realize that this is one of the best things that you could possibly do with your money.
Okay, just so that I don't get this wrong for our viewers, Kartik, the pecking order of sorts as you slowly return to normalcy, and let's also assume that a family has had to take on a little bit of debt because they had to tide over a cash crunch, which has, by the way, been very common. We've seen a plethora of personal loans being given out by banks. Banks have also come out with what we call as COVID loans. So there was demand and there has been disbursement of credit to this tune. So as we get back to our regular income streams and our businesses are back on track, you say start with first amping up your insurance cover, then debt, and then an emergency fund. Is that right?
Right. And this fact that we mentioned about debt, there are lots of us who have over the years bought a lot of insurance policies. We've got home loans running and so on and so forth. So what may happen is not to also try and substitute an expensive loan. I know there is no choice. If you had to take a loan, you've got to take a loan. You've done that, right? But why pay a higher cost? Can you somehow reduce your interest cost on that? So having said that, can you look at, for example, these policies, the endowment version of policies? Most of these insurance companies tend to give you a loan, especially the largest one, the LIC. And a lot of people have these policies. Large part of Indian population has got these policies. So, and those loans are very, very cheap, and there is no pressure of an EMI. You don't have to pay. You're not able to pay. At the end of it, they will adjust that money plus the interest. So substitute an expensive loan with raising loan from such kind of assets that you have already made in the past, if that's convenient, if that's possible. On your home loan, you could ask for a little top up. You have a lot of time to pay. EMIs will be there, but then the rate of interest is very, very competitive versus the other kind of loans that you're going to take. And for the ones who've got more assets, then you have loan against securities, things like that, where again the interest is not as heavy as it is for that matter a credit card loan. So there are some options that you can do even to deal with these loans. So yes, you're right, health insurance, loans, and then contingency reserves. And then of course try and start some investments.
All right, understood. I think, what we'll do, one thing, we'll take on board our questions and queries then. Let me just tell our viewers once again that if you'd like to ask Kartik any question on personal finances, on any, financial problem that you may be facing and you want some tricks and tips on how to tide it over, or if you'd like to, ask us if your investment journey as well is the right one for your goals, shoot us an email. Our email address is themoneyshow@etnow.tv. So let's take our very first question for today. Yadvendra Sahai says, are SIPs and systematic investment plans better than one-time investments and exits? Okay, so basically what he's trying to say is whether you should systematically invest and then systematically withdraw, which means you're just putting money in little by little, and then when you have to withdraw as well, you withdraw little by little, versus a lump sum investment and then a lump sum exit. Which kind of strategy work? Because clearly it's not always a black and white. Sometimes one-time strategy can work, sometimes an SIP one works. So in your view, Kartik, what's better when?
Mobaina, this is actually not even a strategy. This is more a process, and we are trying to compare and find out which process is better. Let me try and explain this in a slightly different way. When you are growing a tree that is going to bear wealth for you over time. You use seeds, you nurture it, you water it, you take care of that little seed from the seed, the shrub, and then the plant, and then the tree. And then you enjoy the fruits of that, and then you also leave the fruits for your family further on. Okay? So SIP is a method of investment. STP is a method of investment. Systematic withdrawal is a method of redemption. Exit and complete redemption obviously is a method of redemption. So these are processes, and a lot of times, people get confused, and a lot of times these marketing, strategy say that is a better way. Look, do what is convenient. Okay, if you've got a lakh of rupees today, go ahead and invest that lakh of rupees. Okay, the standard operating procedure is that when you invest the money, you don't invest all the money on a single day, and you spread it across. Therefore, you use the systematic transfer method of investment. Okay, so you put your money into a liquid fund, break it out. Or if you're buying shares, then you keep it in your savings bank account, and every week or every month you buy a few shares. So that's how you're spreading your buying average prices. Okay, if you don't have a lobby, do an SIP, which is a fabulous facility which has been created by the financial industry so that you can channelize your savings on a weekly or a monthly or a quarterly basis, whichever way you like. So the idea is systematically, in a disciplined fashion, you invest what you are able to invest. Essentially, sum total of this, invest as much as you can, invest as you can, invest on an ad hoc manner whenever you want, and then stay invested. Underline and in bold, stay invested. What is the biggest lesson of last year? Is stay invested. What was the biggest lesson of 2008, 2009 crash? Stay invested. What was the biggest lesson of the 2000 technology crash? Stay invested. So if you're invested in a good product with professionals, even if the portfolio goes down, within about a year or two, things get normalized, it comes back, and then you redeem when you need the money or when your goal is already defined, that I have invested for my child's education, for example, or buying a car in the next 6 years or so, and therefore I've gone and invested, and more or less when you're near to that time, you withdraw that investment and fulfill your requirement. So that's the holy grail of investment. So people get confused and lost in processes. So that's my take on it. Invest what you can, as much as you can, however you can. Standard operating procedure, don't put all the money on a single day, spread it across a week, a month, 6 months, maybe even a year, or what your advisor advises you. But broadly speaking, spread it out and take it only when you need it. In the meanwhile, let that tree of money keep growing for you.
Okay, well, let's take our next question very quickly then. We have Mr. SB Burley asking, is the Nifty 50 equal weight index fund better than the Nifty 50 index fund? And he also wants to know, what's your view on the Nifty Next 50 fund? This is something that we had discussed a few days ago, and that is the beta funds or the smart beta funds, which a Nifty 50 equal weight index fund would be a part of. What's your view? What's the difference, Kartik? If you could quickly summarize that for our viewers.
I would definitely not recommend the Nifty ETF. The reason for that is very simple. The top 5 stocks pretty much make about 40%, and the top 9 or 10 stocks make about 50%. And the remaining 40 stocks of Nifty comprise of the remaining for 50%. So you're not getting a good exposure, which means if Reliance and TCS did take money, because both those have almost about 20% or so in terms of their weight, right? So definitely an equal weight fund is better than a Nifty, a pure Nifty 50 fund. You could also consider ideas like the Next 50 or the Momentum 50 or the Alpha 50, depending on the various ETFs and the products that we have in the market. They give you a different flavor, very, very low cost. I mean, virtually, like a fraction or a fifth of the cost or a sixth of the cost that you would pay versus a regular fund, and maybe about a 40-50 fund. So very low cost, very effective, but I would say avoid the Nifty 50 because that's my personal view. I don't think the index is very well represented if the top 10 stocks comprise 50% of the holdings of Nifty. So that's my view. Equal weight is better, and there are lots of other ideas to consider.
That's the reason why the Nifty 50 equal weight fund has been created. But with that, I think we're out of time, so we're not going to be able to take any more questions. We're still getting so many coming in, but I suppose we'll have to wrap it up. Kartik, really appreciate you joining us today on The Money Show. Thank you so much, as always. A pleasure having you with us.
Thank you.
Okay, that was Kartik Jhaveri of Transcend Consulting sharing with us on how, not just you and your lifestyle, but your finances can get back to normalcy, and we can reverse the equation when it comes to debt and savings. For now, we'll take a very short break, but we'll be back with the chat we had with Mr. DP Singh of SBI Mutual Fund on fixed maturity plans. Don't go anywhere.